The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday, the 28th of February. Welcome back, Jeremy.
Hi, Gareth. Good to be here.
Good to speak to you again. Interested to hear what you've noticed this week. What have you been looking at?
Well, it's just an ongoing storm of stuff coming from the other side of the Atlantic mainly, and Trump's ongoing ability to create cognitive dissonance among everybody else. It just powers on, and Zelensky has gone from being the aggressor dictator only, I think, a few days ago to being a good guy in the space of literally just a few days, seemingly because he's prepared to do a deal, which we're told he's going to be signing in Washington today, I think. I mean, it's just so crazy. It's hard to keep up. And now, because of a nice letter from the King, the UK is Trump's best friend forever.
Yeah.
So, yeah, nothing is the same and everything changes, doesn't it?
No, it is extraordinary. It's all a matter of a few days. You're absolutely right. Yeah.
Yeah. Keir Starmer has made foreign aid his sacrificial offering to help pay for his new big boy defence pants for the safety of Europe. It will create problems within his own party, but what I think it does signify is that Starmer has shown he can take charge and make decisions in a crisis. And I think he did a good job. Key to which is this talk of a US-UK trade deal, which I think would not necessarily just mitigate the impact of tariffs on the UK, but could eliminate them altogether. And I think if this becomes reality, I think the irony here is that Starmer can now reap the rewards of Brexit, because Trump's tariff tantrum seems to be aimed specifically at the EU.
You're right. That Brexit benefit might finally have showed itself. Although I have to say, I'm sitting here slightly uncomfortable because I've spent many years listening to what Donald Trump says and basically not believing a word of it. But now here I am thinking, I'd love to believe Trump. I'd love to believe that this US-UK deal is in fact true and is going to happen with the speed that he was suggesting and be as fantastic as we all hope. Do you think I'm right to believe him this time?
Do you like chlorinated chicken?
If that's the price I have to pay, then maybe I could acquire the taste. Yeah, that's right.
I would offer the following. I think that Trump 1.0, at this time in his last presidency, he didn't know what he was doing. I mean, some would argue he still doesn't know what he is doing, but I think he has now got a team of people around him who do know what they're doing. I think you just saw it in the White House yesterday, lined up against Starmer. Trump was in the company of Vice President Vance, Howard Lutnick, his trade secretary, and Scott Bessent, the Treasury Secretary. Scott Bessent, who's previously worked with George Soros, he understands how markets work. He's told Trump, forget the stock market, focus on Treasury yields, focus on the cost of borrowing. So the objective here is to issue longer duration bonds. Therefore, we need to make those more attractive. And I think that is coming down the line that we as US allies and people who are under the protective umbrella of the US will be expected to play their part and buy these war bonds, if you like. But I think to come back to the point is that Trump now has a team that can deliver on the things he's talking about. And I think Trump 2.0, while you might not like the man, I think there is reason to be hopeful that he can deliver on this trade deal.
And what about from our side? So he's got the people, there's some adults in the room that he respects and trusts and listens to. Who have we got?
Well, I think in that context, I think it was interesting that Starmer's appointment of ambassador in Washington is Lord Mandelson.
Yeah.
He is very experienced in doing these sort of trade deals. He was EU Commissioner for Trade all those years ago. And I think if this signifies a new Keir Starmer taking charge of things, making his own decisions and repositioning towards being able to do a trade deal. I think in Mandelson, he's got someone who is experienced from the UK side of actually driving this through and making it happen.
And how have markets been while all this politics and macroeconomic playing has been happening? What's been going on market-wise?
Not so good, as we suggested earlier. I think the key liquidity-driven risk-on plays of the Trump trade, the Mag 7 and Bitcoin, are continuing their downward descent. Gold has pulled back from its recent highs. Nvidia was down 8% overnight and is now 20% below its peak. And some of the other Mag 7 stocks are really giving up a lot here. Tesla in particular has now round-tripped completely. So the US Trump trade liquidity-driven risk on assets are really struggling. Meanwhile, as we've mentioned before, Chinese equities have recovered. Alibaba is up 50% from its lows. So the big move since the inauguration has been away from the US and into other markets globally. I think the focus for the US administration is it's not the stock market, it's the Treasury market. Treasury yields continue to fall. The 10-year benchmark is now a full 50 basis points lower than at the time of the inauguration. So working away behind the scenes, I think Scott Bessent can be pretty pleased with his first few weeks in office.
No, markets are certainly trusting that they will deliver exactly what they deliver. Not quite sure, but let's see what happens. How about the UK? Not a huge amount of news this week, but there's been a few companies I understand caught your eye.
Well, I'd say the standout UK piece of corporate news this week is the amazing recovery and continued outperformance of Rolls-Royce. We had an amazingly positive update, where it continues to just build on progress across its business in both defence and civil aviation. The shares are now up sevenfold from the low of only about 3 years ago. So the new CEO who came in from BP and has utterly transformed this business. So clearly the defence industry is going through a major change. There's huge changes going on in civil aviation. But this is a business that has just been transformed and is now updated the market this week, where the shares were up 15% on the back of its announcement. And they've reinstated the dividend. They're doing £1 billion share buyback. So this is absolutely powering ahead.
Yeah, it's almost a case study in how to do it right. So yeah, great to see those results.
And I guess the other large cap stock is what used to be called the London Stock Exchange and is now known as LSEG. Yeah, LSEG had its full year results this week. And I just think it's worth highlighting what its CEO, David Schwimmer, said. He said the key highlights for the year include material enhancements to our workspace platforms, the availability of more of our leading data sets across our cloud-based platforms, meeting our customers where they want to work, and continued significant progress across products and geographies in post-trade. In addition, we have been a driving force behind reforms that secures London's position as a global venue for capital raising. Now, note where that came in. This is basically a data business. But in addition, they had this venue called the London Stock Exchange, which I think, if I'm not mistaken, where the LSE in LSEG comes from. I think it just highlights this issue about whether the stock exchange is meaningful in the context of the business that now owns it, which is a data business. So for reference, for the year 2024, LSEG revenues were £8.5 billion, which is impressive, whatever you do. But if you're managing and selling data, that's a great business to be in. Within that, capital markets activities for equities, i.e., the London Stock Exchange, revenues were up 4.6%, driven by an improving market conditions, they say. Average daily value traded in secondary trading was up 13.5% against the prior period. Sounds great, doesn't it?
Yep, I like it.
But it amounted to £236 million, or just under 3% of the total.
Ah, okay. So it really is a data business, cloud-based SaaS delivery for their clients, and it has a stock exchange in addition.
And a world-class data business, and one that is capable of competing one day head-on with someone like Bloomberg. And if that is the case, it should be something that the UK stock market and investors should look after, but whether it should look after the stock market.
Yeah, well, someone needs to. Yeah.
I mean, the irony here is that the only other business that I'm aware of that was trying to create an alternative trading venue to the London Stock Exchange was Aquis Exchange. And the irony there is they're in the process of being acquired themselves by the Swiss Stock Exchange.
Yeah, it is a strange situation that we're in. And yeah, you're right. I mean, interesting to see LSEG's results in a week when actually I've been looking at a couple of other things going on in overseas markets. I did an interview last week with a guy from the OTC, which I remember many years ago as being a place where micro-cap UK stocks would do a listing on the OTC almost as a last resort to see if there was any final opportunity of finding investors when they'd failed in the UK. But they've turned it around. The OTC's performing extremely well. They've got 2,500, 3,000 stocks listed there, and they're really taking advantage of a relaxation of regulation in the States, where basically the US authorities have said, if you're listed elsewhere in the world on a reasonable and sensible stock exchange, and you publish your results and any major news in English and online, then why shouldn't you be listed in the US? And the OTC has been doing exactly that. They've got some phenomenally big companies listed on the OTC. They've got a billion plus index, which includes people like AXA, BASF, Danone, Deutsche Lufthansa, and that's just A to D. So they've got some really, really big companies on there.
Wow.
And we're seeing a number of smaller UK companies adopting an additional listing on the OTC. Small company Concurrent Technologies, a couple of weeks ago, they announced that they were listing on the OTC. I heard from the CEO that they were mainly interested in making sure that their US employees had a way to exercise and sell options locally without all the rigmarole of trying to sell them through a UK broker. So good reasons for Concurrent to do it. Equally good reasons for much bigger companies to do it. And the OTC is getting very good levels of liquidity. They've got a strong and supportive domestic investor base. So they're delivering on a number of things that the UK should or could be able to deliver on in our own right. So it's frustrating to see them doing that so successfully, but fair play and good luck to them. And I would say, actually, for a number of UK small caps, they should probably look at it as an additional source of liquidity. So that's been interesting. And then separately, out of Singapore, hat tip to Charles Hall from Peel Hunt, who noted, I think on LinkedIn, some comments being made by the Monetary Authority of Singapore, who are basically saying they're looking to drive local demand or excitement about the Singapore Stock Exchange. They've issued a pretty comprehensive briefing about measures that they're taking to try and achieve this. They're launching a 5 billion Singapore dollar equity market fund, which is going to be focused on Singapore stocks and needs to be actively managed. So trying to promote activity in that local market, tax exemption for fund managers, incentives for family offices. And on the supply side, they're talking about corporation tax rebates for companies that IPO on the Singapore market. So a raft of measures, some of them I think probably quite expensive or quite significant, but all of them aimed at making the local market more active, more effective in terms of investing, more locally focused, and more attractive to people to list their companies. So there's many of the things that I think should be being done. They are being done by Singapore, and it would be lovely to see them done a bit more effectively here in the UK. So that's a slightly different wrap up on the UK. What have we got coming up next week?
Well, I think politics will continue to dominate. But yeah, in terms of the data, we're getting some US survey data next week. I think the ISM services PMI data could be a helpful indicator for the health of the labour market in the US. It's on Wednesday. On Thursday, we've got a rate decision from the ECB where we're going to see a further cut, I think, coming through. And probably most significantly, we're going to get the monthly crapshoot that is February's non-farm payrolls. So the health of the US labour market is going to be front and centre. The expectation is there's going to be a pickup from last month's 143,000, but this is a highly unpredictable measure month to month. But yeah, the indications have been of a weakening US labour market, and I think the market would like to see a bit of strength there on these numbers.
The strength of the US economy would be useful, yeah. Okay, we've got all that to look forward to, and I'm sure there'll be also headlines about whatever Trump and Zelensky get up to over the next couple of days. So yeah, there'll be a lot to catch up on next week. Good stuff. Thanks for your time, Jeremy. Great to catch up. We'll talk next week.
See you then.
Speak to you then.
Bye.
Brought to you by Progressive Equity.